Welcome back to Talk Tickers. This is the show for the experienced investor, where we don't just read the headlines, we strip mine earnings calls for alpha.
We look at the tone, we verify the tape, and we try to figure out exactly what the street is missing.
We take all that noise and try to turn it into a signal you can actually use.
And today we are laser focused on Enova International, ticker ENVA.
Yeah, we are breaking down their Q4 and full year 2025 results, which just dropped post-market on January 27, 2026.
And I have to say, looking at my screens right now, the vibe is, well, it's confusing.
It really is. We have a classic disconnect between the print and the price.
It's one of those quarters that makes you scratch your head. I mean, Enova posted a definitive beat and raise. The fundamentals look rock solid.
But the price action?
The market took one look at this report, shrugged, and just hit the sell button.
Right. So the stock closed the regular session at what, $157.70? Then the numbers drop, good numbers, which we'll get to. And in the after hours, it just drifts down about 2.3% to around $154.
It's the classic sell the news reaction. But I think there's something deeper happening here.
I agree. The narrative we need to explore today is execution risk versus backward-looking beats.
Exactly. Management is claiming massive momentum, but the tape is telling us that investors are deeply skeptical about the next leg of growth.
And specifically, the integration of that major acquisition that's looming on the horizon.
It feels like the tension between a company doing everything right operationally
in a market that's just terrified of what happens next.
So let's dig into the mechanics of this quarter. Let's start with the hard numbers.
Okay, lay on us.
Sure. So the headline numbers were strong. Adjusted EPS came in at $3.46.
And the consensus estimate was sitting at what, $3.20?
Right. That is an 8% beat.
And for a company of this size in this environment, an 8% bottom line beat isn't a rounding error. That's real operational efficiency.
It is. Revenue was $839 million, up 15% year over year. That also beat the consensus, which is roughly $838.6 million. GAAP net income was $79 million. But the number that really matters here, the one that keeps the lights on, it's the margin.
The net revenue margin stood strong at 60%. And I feel like we gloss over that number sometimes, but maybe we should explain why that matters so much. Why is 60% the magic number here?
Well, think about the business model. Enova is lending to people with, less than perfect credit.
They will have losses.
It's a mathematical certainty. The net revenue margin is your buffer. If your cost of funds and your charge-offs eat up, say, 55% of your revenue, you're barely surviving. But if you have a 60% margin, you have this massive moat against credit deterioration. It means they can absorb a tick up in defaults and still print money.
So you have a top line beat, a bottom line beat, and a fortress margin profile.
And yet the stock drops $3.64 after hours.
And here's where I want to get technical for a second. Implied volatility, or VAC, got absolutely crushed, down about 27% post-print.
That's the IV crush. For listeners who don't trade options, maybe we should break that down.
Yeah, please. What does that actually mean?
Well, going into an earnings print, uncertainty is at its peak. So options are expensive because everyone is paying a premium for that uncertainty, the what if.
Right.
The moment the numbers are released, the uncertainty just vanishes. The event is over. So that premium evaporates instantly.
So even if you bet right on the direction, you could still lose money.
Absolutely. The drop in the stock price wasn't enough to offset the drop in the value of the volatility itself. It's a cruel lesson in options mechanics.
So the market exhaled, the premium vanished, and the stock drifted lower.
Yeah.
But why fade the beat? Was the stock just too hot coming into this?
Context is everything. Enova was up over 40% in the last year leading into this print.
It had a huge run.
A huge run. When a stock is that hard, the bar for earnings isn't just beat expectations. The bar is blow us away and promise us the moon.
It was priced for perfection.
I wouldn't say perfection, but it was priced for certainty. And right now, despite the good numbers, the future holds a lot of complexity. The skepticism isn't about the past quarter, it's about the transition.
The move from a pure play lending story to a complex bank integration story.
And that's the Grasshopper Bank deal. That is the elephant in the room.
For sure. Before we get there, let's look under the hood of the operational engines. Because there was a fascinating divergence between the small business segment and the consumer segment.
This is where the alpha is hiding. If you just look at the top line, you see 15% growth. Nice, steady.
But if you peel back the layers,
you see two very different stories. The consumer business is stable, but the small business, or SMB side, it's a rocket ship.
The numbers back that up. SMB revenue was up 34% year over year to $383 million. But the originations, They skyrocketed 48% year over year.
Almost 50% growth in new loans to small businesses. That's massive. And you have to realize that SMB now makes up 68% of their total portfolio.
It's the dominant engine of the company now.
It is. So why is that happening?
Well, is it that small businesses are just booming, or is there something else going on?
It's a vacuum effect. I mean, think about what's happening at the big traditional banks, Chase, Wells, BofA. They are tightening their credit boxes.
They're pulling back.
They are. They're worried about capital requirements, the macro outlook. So they are pulling back from lending to the local coffee shop or the independent contractor.
So the big banks step back and Enova steps in.
Precisely. Management cited data that 94% of small businesses project growth in the next 12 months. They need capital. But nearly 75% of them are bypassing traditional banks entirely.
And the ones who did go to a bank first?
46% were denied. Almost half were told no.
That is a staggering failure of the traditional banking system.
And that is Enova's opportunity. It's a regulatory and structural moat. The harder it is to get a loan from a bank, the more valuable Enova's algorithm becomes.
Now, on the flip side, we have the consumer segment. Revenue up only 3% year over year to $446 million. It's definitely the tortoise to the SMB hare.
It is. But there was a very specific signal in the commentary that caught my ear. The CEO, Steve Cunningham, he talked about a reacceleration in consumer demand in December.
I caught that too.
Yeah.
He said it was driven by strong credit performance, which let them lean back into marketing.
That's the key. In lending, marketing is a throttle. If you're scared of defaults, you cut marketing. If you feel confident, you spend. The fact they ramped up marketing in December tells me their internal data shows the consumer is healthier than the headlines suggest.
Which brings us to the bear case killer. The biggest fear with Enova is always that the credit cycle turns, defaults spike, and the equity goes to zero.
It's the nightmare scenario, and if you were shorting the stock based on that thesis, this report was a disaster for you.
Because the data says the opposite is happening.
Exactly. The consolidated net charge-off ratio actually improved to 8.3%. That is down 60 basis points year over year.
And the delinquencies.
30-plus day delinquencies dropped to 6.7%. So despite all the macro fears, Enova's borrowers are paying them back more reliably than they were a year ago.
That feels counterintuitive, though, doesn't it? How are they bucking that trend?
It's their machine learning models, and it's that tightening we discussed. Because prime lenders are pulling back, Enova is seeing better applicants flow down to them. They can cherry pick the best of the near-prime borrowers.
Okay, so the core business is humming. SMB is explosive, consumers recovering, credit is clean. So why the long face from the market? It has to be the grasshopper in the room.
The Grasshopper Bank acquisition, this is the strategic elephant. It completely changes the risk profile of the stock.
Let's break this deal down for everyone. They're acquiring Grasshopper Bank for roughly $369 million, expected to close in the second half of 2026. This isn't just buying a competitor.
No, it's a fundamental change in their physics. It's a pivot from being a balance sheet lender
to a fintech with a national bank charter.
And there are two massive reasons why they're doing this and why the market is nervous.
Okay, let's start with the money. Management threw around some huge synergy numbers, $125 million to $220 million annually. Where does that actually come from?
It's the cost of funds. This is the boring banking math that changes everything. Right now, Enova borrows money from Wall Street via warehouse facilities and securitizations. That money is expensive.
Right, they have to pay for it.
When you own a bank, you can take deposits, savings accounts, checking accounts. What do you pay a depositor? Maybe 3%, 4%? That is significantly cheaper than the bond market.
So it's an arbitrage on the cost of capital.
Exactly. But there's a second piece that's even more strategic: regulatory preemption.
The golden ticket.
Right. Right now, Enova has to comply with lending laws in 50 different states. It's a compliance nightmare.
But a national bank charter is federal.
It preempts state laws. It allows them to export interest rates from their home state to the entire country. It simplifies the business immensely.
Okay, that sounds amazing. Lower costs, easier regulations. So why is the market selling the stock?
Because bank integrations are where dreams go to die.
Huh. That's one way to put it.
They are notoriously difficult. You have the Federal Reserve, the OCC. They file their applications, but until that stamp comes through, it's just a plan.
And there's execution risk on the tech and culture side too, right?
Oh, absolutely. The market here is $220 million in synergies and thinks, okay, that looks great in a PowerPoint deck, but show me. It's a show me story now.
So investors are basically saying, we love the lending business, but we aren't paying for the bank until we see the keys in your hand.
Correct. And in the meantime, investors are looking at the 2026 guidance, the clean numbers excluding Grasshopper.
And looking at that guidance, it seems pretty robust. They're guiding for, 15% originations growth and greater than or equal to 20% adjusted EPS growth for 2026.
Which is fantastic. I mean, 20% EPS growth organically in this economy. That creates a very high floor for the stock price.
Let's talk about Q1 2026. They said revenue would be flat to slightly up. But Q1 is always weird for lenders because of tax season.
It is. The tax refund dynamic is really interesting. Q1 is when Americans get their tax refunds. That's a huge injection of cash.
And when people have cash, they don't need to borrow money.
Right. So immediate loan demand drops. But, and this is the important part, they also use that cash to pay off their existing loans. So credit quality improves drastically.
So the dip in demand is temporary, but the improvement in credit quality sticks.
Exactly. Management views it as a net positive. It's like a reset button for their borrower base.
I want to touch on one more thing from the Q&A that I found fascinating, the rate cap question.
The perennial fear. What if the government caps interest rates?
But management's spin on this was classic judo. They basically said, go ahead, do it.
It's the counterintuitive economic truth of price controls. If the government caps interest rates on credit cards, what happens?
Banks simply stop issuing cards to risky borrowers.
They cut them off. And where do those millions of people go when their Capital One card gets canceled?
They go to Enova.
It becomes a massive customer acquisition event for them. It drives underserved borrowers right into their arms.
That is such a bold take, but it makes perfect sense.
It does. It shows how resilient the model is.
Before we get to the trade idea, we should briefly mention the management shuffle. It seems like business as usual, but the names have changed.
Yes. Steve Cunningham is now officially the CEO. Scott Cornelius is the CFO. And David Fisher, the longtime leader, has moved to executive chairman.
They made a big point of emphasizing continuity, though. Fisher is staying for at least 2 years. It felt like a planned succession.
Which is reassuring. You want steady hands on the wheel, especially with the bank integration coming up.
So, to recap, we have a company growing EPS at 20% organically. Credit is improving, defying the bears. And we have a massive acquisition that could transform their entire cost structure.
And a stock price that dropped on the news because the market is skeptical. That is the landscape. A disconnect between fundamental momentum and market sentiment.
Which brings us to the part of the show where we stop being analysts and start thinking like portfolio managers.
It is time for the pitch.
This is the segment where we present a trade idea. But please remember, this is not financial advice. We are just two voices on a podcast.
We don't know your portfolio, your risk tolerance, or your horoscope. Do your own diligence.
Okay, so here's the setup. The market is pricing Enova like a cyclical lender at the peak of the cycle. I'm calling this trade the charter arb, or if you want to be cheeky, the fintech mullet.
I was afraid you were going to say that. Break down the fintech mullet.
Business in the front, party in the back. The business in the front is the legacy lending arm. It's growing EPS at 20% organically. It's boring, profitable, reliable.
Okay, that's the safety.
The party in the back is the bank charter. The market is assigning zero value or maybe even negative value to those synergies from the Grasshopper deal.
So the thesis is that the market is wrong about the integration potential.
The thesis is that you are getting a free call option on the transformation. If they close this deal in the second half of 2026, the algorithm changes. They stop being valued as a subprime lender at 6 or 7 times earnings.
And they start being valued as a digital bank.
Which can trade at 12, 15, even 20 times earnings. It's a re-rating arbitrage. You are front-running the moment when the market relabels the stock.
And how do you play this? You mentioned options earlier.
Well, remember that IV crush. Options are cheap right now. I'm looking at LePaz long-term equity anticipation securities.
Going far out on the calendar.
You have to. You want calls expiring after the expected deal close. Look at early 2027 or even mid-2027 LePS.
Why so far out?
You need to buy time for the regulatory approval. Bureaucracy is slow. If you buy a 3-month option, you're gambling. If you buy a 2-year option, you're investing in the strategy.
So you let the organic 20% growth support the floor.
Right. So you don't lose much if the deal drags on, and you hold the option for the massive ceiling that comes if they integrate Grasshopper successfully.
It's an asymmetric bet. Heads I win big, tails I don't lose much.
Exactly. The downside is priced in, the upside isn't.
The risk, of course, is that the deal gets blocked by the regulators.
That is the risk. But with the stock down after a beat and raise, it feels like the market has mispriced the upside potential.
It's a compelling setup for the patient investor.
So, to wrap this up, Enova delivered a beat and raise. They confirmed stable credit. They are marching toward a transformative bank deal.
And the market sold the news, likely due to fatigue after that 40% run-up. But the fundamentals are screaming momentum.
The disconnect between that 20% organic growth guidance and the negative price action suggests the street is in show-me mode.
And for the investor willing to do the homework, that skepticism might just be the opportunity.
That's all we have for this deep dive. Remember, keep watching the tickers, keep questioning the narrative, and don't let a red tape scare you away from a green business. We will see you on the next one.
Stay sharp out there.